My name is Jake, welcome to the channel. Dividend investing can be pretty intimidating if you're first starting out. As a new or a beginner investor, it can be a little bit challenging and frustrating when you're first setting up your portfolio. I invest with M1 Finance and I really like it because I'm a do-it-yourself investor. I don't invest with a professional, financial advisor. I do everything myself. The portfolio that I put together here in M1 Finance currently has 40 holdings. This portfolio has evolved over the last couple of years, and every single investment I've handpicked in the portfolio so that it meets my needs. This is the interesting thing about investing is everyone has a different time horizon. Everyone is in a different situation. A lot of times we get stuck in the one size fits all, where if one person does one thing, it automatically means that it's the right choice for everyone. And that's just not the case. The truth of the matter is everyone's in a different stage in their life and not everyone is in the same situation. My wife and I are in our mid-30s and we're looking to retire in the next 5 years. And our goals are going to be different than maybe somebody that is in their late 50s or in their early 20s. So it really just depends on your time horizon. Every investment that I have in here serves a purpose. There's a reason why I hold McDonald's in the portfolio as well as Kellogg's. These are two very different companies. I love holding companies like Caterpillar and PPG, but these investments don't make up such a large position in my portfolio as, for example, a Pfizer or an AbbVie. There's a reason why I constructed the portfolio the way that I did. If you're a new investor and you want to do it yourself, you want to learn how to build your own portfolio yourself, and you really want to understand the ins and outs of dividend investing, I'm going to share some different terms in this video that you probably should know. Now, obviously, this video is not going to encompass everything that you need to know about investing or dividend investing for that matter. This video is going to cover really the basics and the essentials that I believe every dividend investor should know. The unfortunate truth is we don't learn about this kind of stuff in school. I took a basic accounting course in college, but I didn't really learn about dividend investing. I had to really learn it all myself. The majority of us, when we were going to school, we probably looked a little like this.
Rachel, Michelle, Hutch.
Gas off, restart. Safety first.
Troy Jeffrey King.
Oh my gosh. Okay, so we're going to go over some dividend investing terms. You can find this sheet in the pinned comment below. This is from the Dividend Reinvestment Calculator. What I did was I added a tab and labeled it Dividend Glossary, and you can check it out. If you want to follow along while watching the video, you can check it out. It's for free. It's just a Google sheet. And so we're going to go over all of these terms. I've added a few here at the bottom, real estate and tax, but in addition to this, what I'm going to do is this section right here, I'm just giving everybody a snapshot. I'm going to go into Seeking Alpha and I'm going to analyze two stocks or use two examples. So I'm going to try to summarize this and really keep it high level and focus on the most important parts of each individual term and kind of reference why it's important. And so if you're looking and analyzing a stock like Coca-Cola, for example, or Costco, these are the different terms that you're going to need to know when you're analyzing a dividend stock. All right, let's take a look at the first one. Dividend investing, also known as income investing, because it's really focused on the cash or the cash flow from the investment, not necessarily the capital appreciation, where the investor is seeking income generating assets to hold for long periods of time. A company that pays a high dividend, but is not really focused on growing that dividend. That would be your general term of dividend investing. Dividend growth investing is similar to dividend investing, where you as the dividend investor are looking or seeking out income generating assets, maybe a company like Coca-Cola or PepsiCo or Costco, and you're intending to hold it for a long period of time. You're not speculating what the share price is going to do in the next couple of years, but rather long term. But with dividend growth investing, the share price is still appreciating, but also the dividend that you're getting paid per share is increasing. That the dividend is increasing per share that you own, and this is increasing year over year. This is what is called dividend growth investing. Now, when looking at a cash dividend, so this is the dividend that you receive as a shareholder. It's the money paid to stockholders generally as part of the corporation's earnings or profit. There's two types of dividend. There's a cash dividend and there's a dividend stock. And I would say 99% of the time when you're watching a video here on YouTube about dividends, it's about a cash dividend. It's the dividend that you're receiving from the company. The next one here, dividend reinvestment plan, or DRIP. You may have heard DRIP before. It's the cash dividends which are automatically reinvested to purchase more stock in the company that paid the dividend. Now, this is one of the big reasons why I like M1 Finance, is because it's focused on the portfolio. When Johnson & Johnson pays me as a shareholder a dividend, that money is then reinvested back into my overall portfolio based off of the target weighting. Let me give you an example really quick. So say, for example, let's look at the activity tab here, Caterpillar. Caterpillar just paid me an $8 dividend on August 20th. I made a deposit of $250 on the same day, and $249 were invested into my brokerage account or into my portfolio. Of that $249, the portfolio, based off of my allocation, purchased the following investments. As you can see here, Caterpillar was actually not purchased. And this is because of my target allocation. What you can see here is what the actual is versus the target. So for example, Caterpillar is an industrial. It's overweight in my portfolio. So this entire slice is overweight. So what M1 Finance does is whenever I transfer money in or whenever I get a dividend, M1 Finance will automatically invest into my underweight holdings. This is fundamentally different than a traditional DRIP. So if you have a brokerage with Fidelity or E-Trade, for example, if you got paid a dividend from Caterpillar, it would be directly reinvested into Caterpillar. And that's the fundamental difference between M1 Finance, because it focuses on the overall portfolio, whereas other brokerages do not. Now let's take a look at the next one, special dividends. A special dividend is a cash dividend made by a company to its shareholders that is separate from the typical reoccurring dividend cycle. An example of this would be Costco. Last year, at the end of the year, Costco paid out a special dividend to every single shareholder, which is kind of cool. If you're a shareholder and you see that, a company really only gives out a special dividend if the company is doing very, very well. And it's a way for a company to reward its shareholders. Now, if you've been a dividend investor for some time now, you probably have heard, of a dividend king or a dividend aristocrat. This is the different terminology here based off of the consecutive years of dividend increases. A challenger is any company that's increased its dividend for the last 5 to 9 years. A contender, the last 10 to 24 years. A dividend aristocrat, this is like the cream of the crop here. It's a company that's increased it from 25 to 49 years. And a dividend king, there's only so many of these companies out there that have increased their dividend for 50 plus consecutive years. For this next section, I'm going to tie it together with Seeking Alpha. So you see the terms here with dividend yield forward, annual dividend payout forward, payout ratio, compound annual growth rate, and dividend growth. It's going to be tied together with looking at a company here on seekingalpha.com. So I mentioned earlier that this is for do-it-yourself investors. So if you wanted to follow along with maybe a company of your choice, you can do it here on Seeking Alpha. And please be aware that this company is always changing, so the fields may be different if you're watching this video a year from now. So when looking at PepsiCo, we're focused here on the dividend section here under dividend scorecard. And what we're going to do is we're going to look at these two fields right here. We're going to look at the dividend summary, we're going to look at the last announced dividend, and we're going to look at each one of these fields, and I'm going to explain one by one what they mean. So the dividend yield, FWD, is the forward dividend yield. And so if you go over here to the sheet here, the expected next 12 months dividend yield divided by the price you paid for a stock. For example, if the company paid $3 per share and the share price was $100, you'd have a dividend yield of 3%. Okay, and don't get confused by the forward. It's just the next 12 months. It's estimated, or expected. Don't get confused by the FWD or the forward. The next one we're going to look at is annual payout forward. So annual payout forward is the expected annual forward cash dividend based on the projection of the company's yearly cash dividend. So essentially it's the same thing, it's just focused on the dividend itself and not the yield. The next one here is payout ratio. The payout ratio is the ratio of the total amount of dividends paid out to shareholders relative to the net income of the company. This is so important. If a company has a high payout ratio, that means that they're probably not going to be able to increase their dividend in the future. There are a few exceptions. For example, companies like utilities or sin stocks like tobacco companies, these companies generally have a higher payout ratio, oftentimes up into the 80, in some cases 90%. However, if you're looking at a consumer good or a company like a Coca-Cola or maybe a PepsiCo, maybe a 50 to a 60% payout ratio is more in line for those kind of companies. If you're looking at a technology company, you want to have a very low payout ratio. For example, like a Microsoft or a Visa, like you generally want to see that payout ratio, 25, maybe 30%, nothing really higher. So it really depends on the sector. But one thing that you want to note is if you look at a company and their payout ratio is over 100%, that is a huge red flag. So really important. Next, let's look at the 5-year growth rate. So this growth rate here, this is the compounding annual growth rate. This is the CAGR. And so let's take a look at what CAGR is. CAGR is the year-over-year growth rate of an investment. This can apply to the overall performance of an investment, so the share price plus the dividend, or just the dividend. When we talk about dividend investing, we're usually talking about the dividend. So the dividend CAGR, really important. The dividend CAGR is so important when you're analyzing a dividend growth stock. Websites will show this in metrics of 1 year, 3 years, 5 years, and even 10 years. I mean, honestly, the further out that you go, it's more representative of historical performance, but generally people use the 5 or the 10-year dividend CAGR. Next here we have dividend growth. Dividend growth is the years of consecutive dividend growth of the company. How many years has the company grown its dividend? Now let's move down to this next section here. This amount here is the quarterly amount of the dividend that was paid. Okay, so this $1.08 for every share that you owned for the last quarter, and there's 4 quarters in a year, you were paid $1.08. So the first one that we're going to look at is the ex-dividend date. The ex-dividend date is where investors who purchased a stock on or after the ex-dividend date will not receive the next scheduled cash dividend. And in this case, it's quarterly. So this date is really important. If you're investing on or after this date, you're not going to be included in the next dividend round that's paid by the company. Next, let's take a look at the payout date. The payout date is the date a declared stock dividend is scheduled to be paid to investors, those who purchased before the ex-dividend date. Next, let's take a look at the record date. The record date is the cutoff date used to determine which shareholders of a stock are entitled to a cash dividend. So let's say, for example, you purchased before the ex-dividend date, and so you're scheduled to get the next dividend, but if you don't hold it until the record date, you are not going to be able to take part in that dividend because you're no longer, a recorded shareholder of that company. So very important. It's usually 2 days after the ex-dividend date. Next, let's take a look at the declared date. The declared date is the date on which the board of directors of a company announces the next dividend payment. So this is when you'll find out what's going to be paid and how much. And then lastly here, dividend frequency. Dividend frequency is how often a company pays a dividend. Most common is quarterly, but there are some investments that pay monthly, semi-annually, and annually. Now let's head on back over to Seeking Alpha and let's go under dividend yield. And so when you go under dividend yield, you're going to see quite a bit of information. The first thing that I want to take a look at is the dividend yield TTM. The dividend yield TTM is a company's cash dividend paid over the last 12-month period. TTM stands for trailing 12 months. The next term that's also important to understand is the dividend growth. Trailing 12-month is the growth change in percentage of a company's cash dividend paid to shareholders over the last 12-month period. It's just important, you understand that FWD and TTM and what that stands for and what it's looking at when you're looking at these different metrics. Next, when it comes to the yield, is understanding yield on cost. The dividend yield is calculated by dividing a stock's current dividend by the price initially paid for the stock. So this is where you really get the value of dividend investing when you're buying into companies that are at fair valuations, because then you can increase your yield on cost. So what does that mean? Let me share an example. So if you were to purchase PepsiCo, PepsiCo's price has obviously gone up and down, right? If you purchased it in 2018, yeah, you were getting about a 2.5% dividend yield. If you were to purchase it maybe in the middle of 2020, you're getting just, around a 3% dividend yield. Now, if we look at really long term here, if you've been a shareholder of PepsiCo for a long period of time, you can see how your yield on cost has maybe, changed over the years. So if you've been a shareholder since 2001, your yield on cost for that initial purchase in 2001 is 9%. However, if you bought a couple years later in 2003, you have a higher yield on cost of 10.5%. Let's say, for example, you bought during the financial crisis, you have a current yield today. If you bought back then and you never sold your shares, you have a current yield of about 9%. This is just one example of a company that has performed very, very well for long-term investors in terms of yield on cost. Next, I want to look at the dividend growth section right here on Seeking Alpha. Now, there is a lot of information to unpack here, so we're just going to cover a few things. The very first thing that I want to cover is the dividend growth rate. So the dividend growth rate is the analyzed percentage growth in a company's cash dividend per share. You can see this displayed here under the 3, the 5, and the 10-year CAGR. So the dividend growth rate is the compounding annual growth rate. So you can see here that if you've been an investor of PepsiCo, you've enjoyed over a 7% increase in your dividend income year over year, well outpacing the rate of inflation. Another term that's really important that you should know is revenue growth. Revenue growth forward is a company's estimated forward sales growth. If a company is not growing year over year, it means that they're going to have a hard time paying you as a shareholder a growing dividend or even sustaining their dividend. So the revenue growth is so important. Another term that's really important that you understand is EPS diluted growth forward. So EPS is earnings per share diluted growth. Diluted is a little bit more accurate when looking at the total security itself instead of just, EPS growth. EPS diluted growth forward is the percentage change between estimated earnings per share for the current financial year and actual earnings per share for the most recent reported financial year, if all convertible securities were exercised. This has to do with the diluted part. So we can see here that PepsiCo has over a 6.5% EPS diluted growth upcoming or estimated. These are some really impressive metrics when we look at PepsiCo. Let's look at, for example, PepsiCo's growth. They have 49 years of consecutive dividend growth. Next year, they're going to be considered a dividend king, which is just amazing. This is one of the best run companies out there. If you look at the dividend growth, you can see that not once did they ever cut their dividend. You can also see that their dividend did also not stagnate, that they increased it every single year. Now, I want to use this as an example with a different company. If we look at another company, for example, Lumen Technologies. Lumen, I believe, if I'm not mistaken, someone can correct me in the comment section below, but I believe that they acquired CenturyLink. CenturyLink, this is a company that I invested in years ago that I got out of once they cut their dividend. I was really attracted to this company with their current high yield. But what you can see is, yes, Lumen Technologies has paid a dividend for 21 years, but this track record is not something that I, as a dividend investor in early retirement, am going to be able to rely on. Could you imagine? You've quit your job, you're relying on your portfolio, and then all of a sudden the investments in your portfolio are cutting their dividend or suspending their dividend left and right, like we saw in the financial crisis of 08 and 09 and the beginning of the pandemic here in 2020. So this is something that you really, as a do-it-yourself investor, really have to be aware of. Another thing that I want to look at is this chart compared to PepsiCo. You look at the revenue growth. Revenue growth is minus 6%. PepsiCo was, 6% positive. EPS diluted growth, negative 1%. The dividend CAGR, negative 10%. This is absolutely atrocious. This is not something that you as a long-term dividend investor really want to be investing in. This is obviously just my opinion, but what I think happens more often than not, and I'm here to say that this happened to me when I first started, is you look at this starting yield, this 8.5% dividend yield, and as a new dividend investor, you're like, whoa, look at this sexy 8.5% dividend yield. But no, your total return, your investment is eroding year over year with investing into a company like this. So that is why it's so important that you understand the ins and outs of not only the business that you're investing in, but the fundamentals of the company that you're investing in. Next, let's take a look at investing into real estate or publicly traded REITs. So first off, what is a real estate investment trust? A REIT is a publicly traded company that owns and or in most cases operates income generating real estate. So this is think of it as maybe a shopping center or a mall or an apartment building that is owned by a publicly traded company that you as an investor can invest in. Next, let's take a look at what an equity REIT is. An equity REIT is a real estate investment trust that owns property which is leased to tenants such as office buildings, shopping centers, and apartments. The way that I think of it is it's an investment that owns physical structures and buildings. Next, let's look at a mortgage REIT. A mortgage REIT focuses on the financing for income-producing real estate by purchasing or originating mortgages and mortgage-backed securities. So here, you're focusing on the finance part of the equation and not the actual building. Next, let's take a look at what a triple net lease is. This is also often referred to as NNN. Tenants in this case are responsible for paying property tax, insurance, as well as maintenance and repairs. So when you think of a lease or a contract, right? Maybe you rent an apartment, you have your lease terms. It's the exact same thing when a REIT, a company, leases out an office building to a tenant, maybe like a FedEx, for example, or a Walgreens. They have a lease, and in that lease, there's specific terms. A triple net lease is the cream of the crop. This is the best lease for landlords because it takes all the day-to-day operations and all the risk when it comes to costs out of the equation for the landlord. So that's why I have it in here. It's really, really important. If you're investing into real estate, investing into companies that operate under a triple net lease is by far the best thing that you can do, in my opinion. Next, let's take a look at funds from operation. This is so important when you're looking at real estate. FFO is the cash flow from real estate investment operations and is used as a measurement of operating performance. How well a company is generating cash flow. That's all it comes down to, is cash flow. And last here for real estate is net operating income. This is used to calculate real estate profitability, which looks at all revenue from the property minus all necessary operating expenses. And the last topic here, everybody's favorite, taxes. So there's a few things that I think are really important for every new investor to understand. I have here return of capital. This is really important if you're investing into REITs. This is very, very important. It's a payment or a return received from an investment that is not considered a taxable event, thus lowering an investor's adjustable cost basis. Now, this is really interesting because a lot of people talk about owning REITs only in a tax sheltered account. But with return of capital, if you never sell your shares, all it does is it reduces your adjusted cost basis, and it's actually very tax efficient or favorable for the investor. And so holding it in a tax sheltered account, unless you sell it, is not necessarily very optimal. In my opinion. Obviously, it differs for every individual, but it's something to definitely be aware of. Next is the Form 1099 Div. This is the tax form used by banks and financial institutions or brokerages to report dividend and distribution income. Every single brokerage at the end of the year, if you have dividend income, you will get this form from your brokerage. And if you're doing your taxes yourself, for example, in TurboTax, all you have to do is upload it or transfer the information from that form into TurboTax. It's super easy. It takes like 2 minutes every year just to do this. If you're a do-it-yourself investor, you should definitely be informing and understanding how your taxes work. Next one here is qualified dividends. This is a dividend that falls under the capital gains tax rate, which are lower than the income or ordinary tax rates. These are companies like McDonald's, Coca-Cola, Pepsi, Costco, Pfizer. These are domestic US companies that are paying you, and you're getting the best tax treatment by owning these businesses. A non-qualified dividend, also known as an ordinary dividend, that does not get taxed at capital gains tax rates because they get taxed as ordinary income. For example, bonds and REITs. So for example, you're not getting any benefit if you're investing into REITs or bonds in a taxable event, with a few exceptions, right? The return of capital that we just talked about. You get taxed at ordinary tax rates like your W-2, right? So if you work a 9-to-5 job, you're getting taxed at the same rate. So those are things to definitely consider. But with REITs, it's not so black and white as it's non-qualified or qualified, because REITs at the end of the year, because of the way that tax laws are written, there's usually a percentage of ordinary income, long-term rates, and return of capital. So I don't want to get too far in the weeds there. I've shared videos entirely on taxes, but yeah, you can check out those videos if you're interested in that. Well, there you have it, everybody. Here were 35 dividend investing or investing terms that I think a lot of you that are following the channel, that this is at least a baseline of where everybody should be at. If you don't understand these terms, continue to research them. This is just really high level what this means. If you want examples, go on Google and search, what is payout ratio? Give me an example of payout ratio, and you can inform yourself that way. But these are terms that every new dividend investor should know and understand. Thank you so much, everybody, for watching. I hope that this was helpful. I know that this is maybe not the sexiest topic, but I know that there's a lot of new investors out there that are following the channel, and it is so important that you understand these basic terms when it comes to investing as a do-it-yourself investor. I hope everybody has a great week, and I'll catch you all in the next video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.